that changes the narrative, and eventually the Fed, sometime in the summer, are going to go, and probably after the June meeting, they're probably going to go, okay, we'll monitor the situation, and maybe we won't tighten the balance sheet yet. That signal is the signal for risk assets, I believe. And I think we'll see growth end of tech, which has been utterly destroyed and is down 70% plus, and crypto, and probably gold actually, start to outperform along with bonds. And those should be the phoenix that rise from the ashes, and some of these other more cyclical plays will do less well. Those are the things that have been outperforming over the last 18 months. The big question is, what is it going forwards? Is this going to be a longer recession, in which case everything rallies and then comes back down again, the Fed have to do a lot more? Is that what brings the Fed balance sheet in? Is the markets roll over and the economy looks terrible? I'm not sure. My base case scenario is a V-shaped recovery from a absolute cliff edge. But it could be something more drawn out, in which case we've got a much nastier equity bear market to come. But I think this is the opportunity I've been looking for. I've been buying technology stocks gradually on a dollar cost average basis over the last couple of months. I will probably go out another month, and that will give me hopefully this whole low period if I get this right. The weekly DMARC indicators give us between 2 and 4 weeks for this low to come in. Crypto is identical right now. We've got the bad signal of we need the dailies to get where we're going, and that's probably another week or 10 days away of this kind of price action that we've been seeing, which is pretty ugly. And the weekly indicators are somewhere between 2 weeks and 5 weeks away before we get the final capitulation lows. It was that DMARC setup that got me out of being short, or out of my shorts and out of many trades in the pandemic as well. And I take them very seriously because they usually lead to very good signals. So that's my whole view in a nutshell. So I think it is the economy. I think every time the ISM starts hitting 50, they realize, okay, the economy's going down. Because what does ISM 50 mean? It also means unemployment goes up. ISM 50 is almost certainty every time ever historically that inflation comes down. So it's going to give you that. It's going to give you the rate of inflation coming down. They know it's going to come down because of that. And I think that they're going to find that, sorry, I've gone out of focus for something. There we go. The rate of inflation comes down, the economy goes down, and unemployment goes up. Now, if you listen carefully to what's going on with the tech companies, they're laying off people. Amazon said, their words, they were wildly overstaffed for demand. Everybody's built up massive inventory, so we've got an inventory liquidation to come, which drives down ISM dramatically and GDP growth. And tech companies are going to be laying off staff. Every single VC has kind of said to their investment class, hey, listen, you need to reduce your costs. And I think that message is not lost. So that's what's to come, and they'll see it very fast if I'm right and ISM comes off really quick. And that's the balance they're trying to walk. As you said, break-evens, 5-year break-evens are off 100 basis points. So they're down at 3%, at 2.8%. Now, it's not very long. If I'm right in what's happening, those 2-year break-evens are going to be back in the kind of 2.5-2% range, which is where the Fed wants it. So what they need to see is the headline rate of inflation come down, which is going to start turning down, and then they'll be okay. Now, don't forget, they started cutting in 2001 and 2008 and 1974 and 1984 before inflation peaked. So it is possible. Maybe it's where we are in the election cycle means they won't, but they're going to lose an election if they destroy everything. Because if your purchasing power has been destroyed by the inflation and then you're out of a job, I mean, you're double fucked. And that is not good for winning an election, or midterms anyway. It's kind of irrelevant because the market did it itself. I mean, the bond market did what it was supposed to do. It's like, fuck, inflation's coming, let's raise rates. They raise rates. Now, we don't borrow at Fed funds. We borrow at these money market rates that are driven off the actual natural interest rate curve, and it did all the tightening. So, and it's going to do the loosening before Jay even figures this out. So it's almost irrelevant. It's kind of suggests that you don't need the Fed except in the backstop scenario. when interest rates aren't enough, that the Fed are kind of irrelevant in the equation these days, that the markets can do it. It's only in the really bad scenario when they need their balance sheet to avoid worst case outcomes. I know people are like, I hate the printing of money, but imagine if they had not in 2008-9. Imagine if they had not in the recession. I don't know how bad it would have been. So it's either a total destruction of everything, or it's a destruction in your purchasing power. There's, nothing comes for free. Well, also, if you step really far back, what is the big issue here? We've got too much debt. The 1940s and 50s, we had the same coming out of World War II. In fact, it was very similar because we came out of World War II, there was not enough supply of commodities, and all the people came back into the workforce and back into normal life. Exactly the same. Commodity inflation took off, interest rates went up, the economy collapsed, inflation went negative, it then kind of had a rebound effect and then eventually settled down. And over that period, how did the debt disappear? The debt disappeared from negative real rates over an extended period of time, which is you need to keep interest rates low or you debase the currency, and they had yield curve control. So you're basically debasing the currency, keeping inflation slightly low, but higher than the interest rates, and you run that for an extended period of time. What was amazing about the 1950s and late 40s was it was a period of amazing growth. Equities went up 900%. The economy, we had massive fiscal stimulus like we're going to see now. We're going to see that now as supply chains come back. And the rise of technology. That was the rise of TV, domestic appliances, and all of the life-changing things that came in the 50s. I think we're set up for that again. So I actually think we're about to go into a golden age, which I know people don't want to believe, but nobody believed it back in the 1940s either, because he'd just come through 2 world wars and they thought, well, everything's screwed forever. And much like you didn't believe it in the 1970s because you'd gone through this inflation driven by the demographics, but the net outcome for the next 40 years was the biggest boom of all time. So I'm much more constructive than the mainstream narrative, which is this is the worst thing. Now, I understand that running negative real rates means that purchasing power doesn't go up. Wages are not going up. So owning assets is the only way of doing it, and assets should outperform debt in a negative real rate environment. So it's doable. If you're a saver, it's bad. But what does it do? It forces you to buy assets. Now, assets have generally roughly been in line with the Fed balance sheet. The only 2 things I've found that have outperformed the Fed balance sheet since they started using it in 2008, 2009, the only 2 things is NASDAQ, so technology stocks, because there's a massive secular technology adoption going on, and the other one is crypto, Bitcoin. Those 2 things, because that's a Metcalfe's law adoption model. That's very different than the S&P, for example. So negative real rates, I don't think is bad. I think it's the only way of reducing. So financial repression is the way of reducing the debt. You need to own the right assets to offset it. So you just need to make the right asset allocation choice. Where it's hard is for retirees who don't want to take risk in assets. So the retirees kind of get screwed, but the baby boomers are the people who caused this in the first place. So their retirement is not easy, and they need to be careful about that. The other side is the short-term impacts of inflation will continue, and therefore it's stagflation. And that's another form of destruction, but you need to be involved in commodities for that. I understand that, but my work suggests that can't be the case. I just give it a low chance. Now, does that mean that commodities go down? Maybe not, but they just need to go sideways for the year-over-year rate of change to go to 0. The structural story is more interesting to me. The structural story is that this deglobalization, ESG spending, rising commodity prices leads to long-term secular stagnation. And that will destroy basically earnings in equities and destroy future wealth, and leads to a commodities 1970s bull market. There's a possibility